Hello everybody, and welcome to the March edition of the Rainey Review. On this slide, we show the growth of $1 invested in various asset classes over the 3 months ended 31 March 2025. A somewhat sombre looking slide, with the bad, the middling, and a bright ray of orange. Leader for the 3 months this time is global infrastructure in orange, where $1 invested 3 months ago would have grown to $1.07. In a somewhat surprising second place, given the rhetoric about emerging markets economies coincident with tariffs, is emerging market shares in red, where $1 invested 3 months ago would have grown to $1.02. In the middle of the pack, amongst the fixed interest and the cash, is a 50-50 mix of shares in property and cash and fixed interest, which would have grown to $1.01. After that, it begins to look a little bit grim, with international, Australian and New Zealand shares in property all delivering negative returns for the quarter. Not a great start. This slide shows the growth of $1 invested in those same asset classes now over the 12 months ended 31 March 2025. The leader, again, is global infrastructure in orange, where $1 invested 12 months ago would have grown to $1.26. In second place, also again, is emerging market shares in red, where $1 invested 12 months ago would have grown to $1.13. Middle of that crowded pack is a 50-50 mix of shares in property and cash and fixed interest, where $1 invested 12 months ago would have grown to $1.07. Given the poor quarter and the alarming news over the last 12 months, that's a really good result. But I always say 1 year is not long enough. We always need at least 3 years' data. This slide shows the growth of $1 invested in those same asset classes now over the 3 years ended 31 March 2025. The leader over 3 years is unhedged international shares in Navy, where $1 invested 3 years ago would have grown to $1.53. In second place is global infrastructure in orange, where $1 invested 3 years ago would have grown to $1.41. In third place, in red, is emerging markets shares, where $1 invested 3 years ago would have grown to $1.28. Middle of the pack is that 50-50 mix of shares in property and cash and fixed interest, where $1 invested 3 years ago would have grown to $1.15. Hardly shooting the lights out, but a pretty solid result. Again, with apologies to Lionel Shriver, author of the excellent, if somewhat difficult to read, We Need to Talk About Kevin, we need to talk about Donald. I had hoped, when I talked about Donald Trump in my last Rainey review, that I wouldn't have to again. That was clearly too ambitious. Given the tsunami of Trump and tariff talk over the last month, it's apparent that I need to talk about him again. As a reminder, here is a chart that shows the performance of the S&P 500 index under US presidents going all the way back to 1953 and the first term of President Dwight D. Eisenhower. On average, it doesn't matter who the US president is or which party they represent. The S&P 500 index will return around about 10% per annum. Sir John Templeton, renowned investor, fund manager and philanthropist, was once described by Money magazine in 1999 as arguably the greatest stock picker of the century. One of his most profound observations is that the 4 most dangerous words in investing are "this time it's different." Those of you that are watching me again will know that's not a statement I will just leave hanging. I'll look at the evidence. Since President Trump's election, and in particular since his so-called Liberation Day on 2 April, markets have experienced elevated volatility. Over the 2 days following the commencement of the tariffs, well, the initial commencement of the tariffs, the S&P 500 index fell 10.5%, unsettling and understandably worrying. But was that fall of 10.5% unusual? Not particularly. These two tables show the 10 worst 2-day price movements in the S&P 500 index since 1950. From the Black Monday stock exchange crash in 1987 to the recent, and worse, fall in prices during COVID, 2-day falls are not rare. To understand the impact, we also need to look at what happens after the falls. The first table, on the left, shows the worst 2-day price movements and the average price move 1, 3, 6, 12 and 24 months later. Every incidence of a fall was completely recovered 2 years later. 90% were recovered after 1 year. The second table, on the right, shows the 10 worst 2-day price movements and the best 2-day price movements in the following month. On average, there were subsequent recoveries of greater than 10% within a month of all of the falls. Markets rise and fall over time, not only over the course of, but during the year. But the question is, should we be worried about that? This chart shows the average calendar year performance of the S&P 500 index since 1980. Over that time, the average return has been 12.1% per annum, which is a great return over 44 years. Over that same time, the average maximum intra-year market fall from peak to trough, called a drawdown on this chart, has been 14.1%. Amongst other things, this shows that market falls of 10%, like the one experienced over the 2 days following Liberation Day, are not only not unprecedented, they're not even that unusual. Despite the fact that the S&P 500 has, on average, experienced a fall of 14.1% at some time during every year since 1980, it has still delivered a return of 12.1% per annum. But the hard thing is that to earn that return, we have to experience discomfort along the way. That's what successful investing is all about. One of the most important jobs of a financial advisor is to help clients retain long-term perspective in the face of short-term volatility. If we can remain disciplined in the face of risk and uncertainty, we will be rewarded over time. In the meantime, which is unfortunately in the short term, when we hear the words unprecedented, unmatched, unparalleled and unique, know that in some way they will describe the times we're in, but not when it comes to investing, because it's never different. Thank you for watching. I look forward to updating you again in the next edition of the Rainey Review.